Hey everyone, and welcome back to the channel. Today, we're diving deep into the glittering world of precious metals. If you've been watching the markets, you've probably noticed that gold and silver have been on a wild ride lately. One day they're soaring, the next they're taking a dip. So what's really going on? Is this just random noise, or are there bigger forces at play? In this video, we're going to break down the three key drivers behind this volatility: geopolitical tensions, shifting monetary policies, and the ever-powerful US dollar. By the end, you'll have a much clearer picture of why these ancient assets are behaving the way they are and what it could mean for the future. Let's start with the most dramatic factor: geopolitics. Whenever there's instability or conflict on the global stage, investors get nervous. They start looking for a safe place to park their money, a safe haven asset that holds its value when traditional investments like stocks feel risky. For centuries, gold has been that safe haven. Think about it. It's a physical asset. It's universally recognized. And it's not tied to the success or failure of any single company or government. So when tensions rise in regions like the Middle East or Eastern Europe, we often see a flight to safety. Investors and even central banks around the world start buying up gold, which pushes the price up. Silver often follows gold's lead, though it has its own unique characteristics we'll touch on later. This isn't just theory. We've seen it happen time and time again. A sudden flare-up in global conflict can cause gold prices to spike overnight. Conversely, when tensions ease and diplomatic solutions seem possible, that fear subsides. Investors might feel more confident moving back into stocks, selling some of their gold, which causes the price to pull back. This constant ebb and flow of global risk is a primary reason for the short-term volatility we're seeing. It creates a fear premium on the price of gold, making it a real-time barometer of world stability. Now, let's talk about the second major piece of the puzzle: monetary policy, specifically interest rates. This one is a bit more technical, but it's absolutely crucial to understand. Central banks, like the US Federal Reserve, use interest rates to manage their economies. When they raise interest rates, it becomes more attractive to hold cash or government bonds because you can earn a decent yield or interest on them. Gold, on the other hand, pays no interest. It just sits there. So in a high interest rate environment, the opportunity cost of holding gold is high. You're giving up the chance to earn that guaranteed return from a bond. This tends to put downward pressure on the price of gold. People might sell gold to buy assets that offer a yield. On the flip side, when central banks cut interest rates, the opposite happens. Suddenly, holding cash or bonds isn't as appealing because the returns are low. In this scenario, gold becomes much more attractive as a store of value, especially if inflation is also a concern. This is why market watchers hang on every word from the Federal Reserve. Any hint about whether they're going to raise, lower, or hold rates steady can send shockwaves through the gold and silver markets. The constant speculation and changing expectations about future rate hikes or cuts are a massive source of the price swings we're witnessing. The third and final driver we need to discuss is the US dollar. Gold is priced in US dollars globally. This creates an inverse relationship between the two. When the US dollar gets stronger compared to other major currencies, it takes fewer dollars to buy an ounce of gold. As a result, the price of gold in dollar terms tends to fall. A strong dollar makes gold more expensive for investors holding other currencies, which can dampen demand. Conversely, when the US dollar weakens, it takes more dollars to buy that same ounce of gold, so its price goes up. A weaker dollar makes gold cheaper for foreign buyers, which can boost demand. So, what makes the dollar strong or weak? A lot of things. It's influenced by the health of the US economy, the interest rate decisions we just talked about, and its own status as the world's primary reserve currency. When the global economy looks shaky, investors often flock to the US dollar for safety, just like they do with gold. This can create a confusing tug of war. Sometimes fear drives both gold and the dollar up, which is unusual, but most of the time you'll see this seesaw relationship: dollar up, gold down, and vice versa. Watching the US dollar index, or DXY, can give you a great leading indicator for potential moves in the precious metals market. So we've covered the big three, but what about silver? Why is it often called gold's volatile little brother? Well, silver is a fascinating hybrid. Like gold, it's a precious metal and a monetary asset, so it's influenced by all the factors we've discussed: geopolitical risk, interest rates, and the dollar. When gold rallies as a safe haven, silver often gets pulled along for the ride. However, silver also has a huge industrial component. Over half of all silver demand comes from industrial applications. It's used in everything from solar panels and electric vehicles to electronics and medical devices. This means silver is also sensitive to the health of the global economy. If manufacturing is booming and there's strong economic growth, industrial demand for silver increases, which can push its price up. But if a recession hits and industrial production slows down, demand for silver can fall, putting downward pressure on its price. This dual nature, part precious metal, part industrial metal, is what makes silver so much more volatile than gold. It's being pulled in two different directions at once. It might be trying to rally with gold due to fear, but at the same time, it could be getting pushed down by worries of an economic slowdown. This internal conflict often leads to much larger price swings, both up and down, compared to gold. So, to wrap it all up, the recent volatility in gold and silver isn't random. It's the result of a complex interplay between three powerful forces. You have geopolitical tensions creating fear-driven demand for safe havens. You have central bank monetary policies, especially interest rates, changing the opportunity cost of holding non-yielding assets. And you have the fluctuating strength of the US dollar, which directly impacts the commodities pricing. When you layer silver's industrial demand on top of all that, you get the perfect recipe for the market swings we've been experiencing. It's a dynamic and fascinating market where global events, economic data, and investor sentiment collide. Understanding these key drivers won't let you predict the future with perfect accuracy, of course, but it will give you a solid framework for making sense of the chaos and understanding why these timeless metals are moving the way they are. Hopefully, this breakdown has been helpful for you. Thank you so much for watching. If you found this analysis useful, please hit that like button and consider subscribing for more deep dives into the markets. Let me know your thoughts on gold and silver in the comments below. Where do you think prices are headed next? I'd love to hear your perspective. Stay safe, stay informed, and I'll see you in the next video.